Welcome to the Supplemental Charts Update. This is a video that I do each week where I look at charts and information outside of what I create myself just to get some insight and information about what's happening in the market. Unfortunately, some of these charts don't have a lot of explanation, so I have to kind of try to interpret what is going on inside the chart. Usually I get it right, but sometimes I might get it wrong. But the idea behind this is just to analyze any amount of information to try to give us some kind of an edge as to what's happening in the market. This is being prepared for Monday, March 13th. First, we look at sentiment. This is a little outdated where the graphic that we use has this more extreme in the fear camp. The last time this came out, it was tilting a little bit more to the left-hand side as far as sentiment. Sentiment has been really complacent lately as the market's been going down, at least in the latter part of last week. And we're seeing if fear will actually bounce up to produce some kind of a washout situation to give the market a chance to bottom and then possibly start to go back up. Also, we look at the overbought, oversold composite, and we're getting close. Once we drop below 25 on this chart, that is an extreme negative reading. Currently, we're at 29.15. A week ago when I did this video, those that are likely to increase exposure over the coming days, it had really been dropping. It had been at 35%, still thinking they're going to increase their exposure. This week, that has dropped down to 30%. We also look at the active asset managers. This survey is a week old, and it's right up around the neutral point at 60.11. Since we had a difficult week last week, it won't be a surprise if we see this decline in the next reading. Looking at the economy, these are the consensus figures for the top 10 and bottom 10 folks that predict what GDP will be. On the top end, we're just under 2%, probably about 1.75%. And then on the bottom, we're down around 1% or so. Here's another graphical look at that, showing how the GDP now forecast is suggesting that we'll be at 2.6%. So that's positive rather than being negative. Then we look at a global measurement of GDP and how that's holding up in the G5 central banks. We're currently down 14% overall. This looks at the ISM, and a reading under 45 historically has coincided with negative payrolls. We're currently at 47.7. We haven't dropped below that 45 level yet, but we're still seeing really strong employment numbers, where this is the February report that came out with 517,000 new jobs being added. The report that we just received last Friday was still very strong, and so we'll have to see if the ISM manufacturing PMI continues to decline or turns and goes back up. This looks at initial jobless claims. They spiked up a little bit overall, but they continue to be low, suggesting that the employment situation is still quite strong, at least on the surface. This looks at all employees as well as temporary help services. That's the red line, and it has been decreasing. The blue line is real GDP, and it's also been decreasing. If we drop below this red line, that could suggest that we go into a recession. At least that's what has happened in the past. This looks at mortgage applications. We're really starting to see a decrease in that because housing prices are going up and interest rates are going up, so it's pricing out of the market a lot of would-be buyers. On this chart, it just suggests that it's the lowest level since 1995. This looks at the inflation nowcasting, where it's been flat over the last week or so, but has been ticking up slightly as we look at CPI and PCE inflation. We will be getting the CPI reading on Tuesday, March 14th. Looking at earnings and valuation, this is put out by Morgan Stanley, where they say our leading earnings model suggests significant downside to earnings per share growth ahead, where their leading earnings indicator has been declining, as has the actual earnings per share, and they're projecting that earnings will continue to fall, which could really put a lot of pressure on stocks. This looks at the S&P 500 level and the earnings per share. What will we be at is kind of a forecasting model. The current price is at about $39.81. We're even below that now, where if we stay at the current earnings rate, we should be at about 4,000 by the end of the year. The adjustments that they make, where they are saying the S&P will be at $222, they expect that to climb in 2023 and then climb even more in 2024, and that could see a real rise in the S&P 500. There's other data to suggest that this is overly optimistic and earnings per share are still headed lower. This looks at the M2 money supply percent and the rate of change against GAAP earnings. When there was a huge influx of money into the U.S. economy, that really helped the earnings for companies. Well, since money's been coming out, we're seeing earnings also starting to go down. This looks at the bottom 450 S&P 500 stocks and suggesting that they still remain cheap, where the 50 stocks, those are the big ones, the ones that you probably have heard of, they are still relatively expensive. Here's the LEI, or Leading Economic Index, a 6-month rate of change against the earnings for the S&P 500. Shows that they are both declining. Saw a little bit of a tick up with the LEI, but earnings still continue to be under pressure. This looks at the S&P 500 earnings yield against the 6-month U.S. money and U.S. investment grade yield, showing how they're both going up. And we're seeing this right now in the market. We hit some trouble in the previous week with the shutdown of the Silicon Valley Bank. Some folks are really seeing a fearful situation out of that, and so they're getting out of stocks and getting into bonds because the bond yields are much more attractive, since many of them are now at around the 5% level. This looks at the deviations of earnings either above or below long-term growth. We're still above that long-term growth trend. This looks at the forward earnings yield minus the 10-year Treasury yield, how it has really been coming down as earnings have been coming down. And even though interest rates are going up, the earnings are having more of an impact on this chart. This looks at the 12-month forward PE ratio. That's what the stock market uses. We also use the trailing 12 months to get some insight as to what's happening in the companies. The FANG stocks, which I'm still going to pronounce as FANG even though they changed the acronym, that's the dark blue line here, how their earnings are starting to come down. If you take the FANG stocks out of the S&P 500, we're pretty much flat currently. This chart just says China's cyclical upswing is bearish for the dollar. So if China continues to recuperate, that could put some real pressure on the US dollar. This looks at risky against safe asset fund flows. A lot of people are getting out of the risky fund flows because they're seeing a lot of danger and they're having a tendency to get back into bonds. This looks at the investment grade bonds and how money has been coming back into them. This is how much do clients of Bank of America hold in debt, meaning bonds. It had been pretty low at 17%. Well, now it's starting to climb. Cumulative fund flows across different assets. The dark blue line is equities, followed by government bonds. We're seeing a lot more money coming into that. The blue line is money market. There's still an awful lot of money in cash. And then the light blue line are corporate bonds. This chart looks at discretionary, meaning you can change around and get in and get out when you want to, versus a systematic strategy, which is where you stick to a plan and don't deviate from that. They're both seeing a little bit of improvement. This compares announced buybacks by companies against what actually happened. The blue line is those announcements that are made. The green line shows what has happened in real life, going pretty much flat currently. This is also another look at announced share repurchases. The 3-month average is this red line. It's usually seen as positive when a company buys back their own stock. That takes shares out of the market, which makes them more precious, and it's just a sign of strength when a company is willing to put its money into itself. Here's the insider transaction ratio. We're starting to get a little bearish again. We had been up around the bearish level about halfway through January, and that started to really drop. It got to a bullish signal again, and now it's been going back up. When we get to 12 or above, that's where it starts to get more bearish. This suggests that cash is king again. Highest cash inflows going back to 2020. This suggests that treasury inflows are still robust as money is going into bonds. This chart says the G4 central bank's balance sheet is poised to contract by $2 trillion by the end of 2023. The fact that this had been going up was giving a lot of support to stocks. As this is going down, that could add to the pressure. Here's an interesting chart. I'm sure you were all around the last time this happened. This says the lowest interest rates that we've had in 5,000 years going back to 3000 BC. The dark blue line are short-term interest rates and the light blue line are long-term interest rates. So it may seem like interest rates are really going up, but historically they're still quite low. This chart just looks at the Fed futures to see what will interest rates be. And I use something different called the Fed Watch tool to get something a little more easy to interpret, but this just presents it in a little bit different way. The last reading that we had is kind of this dark blue line on the very top, suggesting that we might see a 50 basis point hike at the upcoming meeting on March 22nd. This chart is suggesting that bonds are becoming overvalued or expensive. This is the MOVE index, which is like the VIX for bonds, how it has been decreasing overall, even though the chart that I show in the weekly video shows that it has been going back up. And it compares this to the equal weight S&P 500 index. This is what will interest rates likely be when the Fed stops raising them. Right now they're saying it'll be at about 5.63%. This chart looks at how are we now compared to a week ago. The purple line is suggesting that interest rates would not be as high and they are declining before they top out. The blue line, after Chair Powell gave his speech before Congress, bumped that up. Although this is descending, it is still higher than what had been projected about a week ago. This suggests that in October of 2023, we might get up to 5.7% before coming down, and then by the end of 2024 be at 4.2%. This is just a historical chart showing how the Fed started to raise interest rates and then something broke along the way. What a lot of people are thinking right now is, with that bank shutdown with Silicon Valley Bank, is that going to be the beginning of something that breaks itself to a larger degree, or is that just an isolated case? This measures the exposure to bonds, where it had been coming back up, but now is starting to go back down, which contradicts some of the other charts we've looked at. This looks at European values against the U.S. and the 10-year bond yield, where European stocks have really been going down overall. This is the JP Morgan forecast, is the dashed blue line. This is looking at Germany and where will their rates be when they top out. Currently, they're suggesting it will be at 3.35%. This looks at how many foreign investors own U.S. treasuries. It's about 30% right now, but this just suggests that U.S. bonds are still owned largely outside of the U.S. Looking at the S&P 500 in stocks, the Bank of America private client equity holdings as a percent of their assets under management, it had been at 66%, has now been coming back down as we've seen some weakness in the market. This compares cash allocation against long-term average, where we're below average overall. There's still an awful lot of cash out there. Here's a technical chart, very similar to the charts that I show in the daily and weekly videos. This is a bit outdated now because we broke through both of these levels of support and now we're headed lower. We have reached a pretty severe oversold condition that may produce some kind of a bounce that could take the market higher, but we need to see buyers really come in to help that turn more positive. This says the S&P 500 makes an impressive, successful test of critical support. Well, this chart is a little outdated because right now we have not successfully tested that support. A lot of people use a 60% stock, 40% split in their portfolio, and it just shows how yields have been really coming down, which is very frustrating for investors. The Nasdaq today is coming real close to what the Dow was doing back in the 70s, just as kind of a comparison chart. I think these are interesting. I don't use them exclusively. A lot of people make decisions based on this. What I see is we might have a pattern that has already happened before, but eventually that pattern breaks down. But it's still interesting to keep an eye on them. This suggests that the Fed and Wall Street were codependent from 1966 through 78. This is another historical chart that you may want to pause and look at just to see different events that have happened. Looking at current market valuation, we're still fairly valued overall, as best I can tell. They don't have that screen anymore, but the yield curve model is still suggesting that we're highly overvalued because the yield curve remains inverted. The state coincidence index model is also high. 22 out of the 50 states are having a rising SCI, which if we get above 25 in this reading, that generally means that most of the country is in a recession. The margin debt model hasn't changed because it hasn't been updated since the end of January. It's still considering that we are neutral. The PE model is suggesting that we're fairly valued since we've dropped down. Because of the weakness that we saw in the market, we dropped below this one standard deviation level. The interest rate model is above the midpoint and advancing, but it's not giving us an extreme reading, so it is fairly valued. This is the S&P 500 mean reversion model. We're back down to fairly valued. We poked just a little bit above this one standard deviation. Well, with the weakness that we saw, we've dropped down below that. And the junk bond spread is still giving us a neutral reading. We're below this historical trend line, but not giving an extreme positive or negative reading. Looking at FactSet, they say larger cuts than average to the earnings per share estimates for the S&P 500. Companies that are reporting in the first quarter, it's down at about 5.7%. This next post asks the question, are fewer S&P 500 companies concerned about a recession? This is the number of times that they mention a recession in their earnings call, and it's really been dropping off. This is the Real Investment Advice Economic Composite Index against GDP growth. They are both declining, where this is just showing that economic growth is going down, where GDP is holding up. One of these will probably have to change. Is the index going to start to go back up, or is GDP going to start to come back down? This looks at the same index against the LEI, looking back 6 months with a rate of change, where they are both declining overall. That's suggesting economic weakness. This looks at the annual change in the S&P 500 against the liquidity measure where they are both decreasing, and that could put some pressure on stock. The liquidity measure is the M2 money supply minus GDP. This is something from a consumer standpoint that's more interesting, where it says the total delinquent consumer loans in the U.S. are really starting to go up as a lot of the grace periods that we saw during the COVID lockdown are starting to go away. Thank you. I hope you found this helpful. Please feel free to check out the daily video, the weekly video, the intermarket analysis video. I also post a deep dive video where I look at charts that I don't really cover in the videos. I hope you have a great week, and I will talk to you in the next video.